I greet you, ladies and gentlemen, as I start this session of my video lecture, where I'm going to be dissecting the relationship between inflation and unemployment, both in the short run and in the long run. To operationalize this, I'm going to be sharing my screen. So the module is still Central Banking and Monetary Economy, CPA 213. What we are looking at is the relationship or the trade-off between inflation and unemployment. So the credits, I had to rely on a number of sources, but my main source for the preparation of this lecture was an article online entitled "The Relationship Between Inflation and Unemployment." It is found on that website. When we are looking at the relationship between inflation and unemployment, we by necessity have to start the Phillips Curve. It's also called the Phillips Curve theory. The Phillips Curve is a diagram or a curve which shows an inverse relationship between inflation and unemployment, implying that as the unemployment rate decreases, the inflation rate increases. Ceteris paribus. And this relationship is attributable to an engineer turned economist called Arthur W. Phillips, who published his observations about the dynamics or the inverse correlation between the rate of change in money wages and the rate of change in unemployment in Great Britain in 1958, whilst he was starting stabilization policy. And from his data was from 1861 to the late 1960s, at a later time, and it was confirmed that when we are looking at a long-run data, it was confirmed that the relationship actually breaks down. But for short-run data, the data of 1958, and a few years prior to that, the short-run Phillips curve, or the trade-off between the rate of change in money wages and the unemployment rate was confirmed. So it was discovered that when you are looking at a longer range of data, the relationship between the two variables became unstable and in some instances broke down. So the Phillips curve is a graph or a diagram which depicts an inverse relationship or a negative relationship between the unemployment rate and the rate of inflation in an economy. And in his studies, whilst starting stabilization policies, Arthur W. Phillips and others who investigated this relationship between unemployment and the rate of inflation, they discovered a phenomenon, or rather they observed a phenomenon which is known as stagflation, which is a scenario where inflation is accompanied by a stagnation in economic growth, unemployment, or a recession. The Phillips curve itself relates the rate of inflation, or the rate of change in money wages with the rate of unemployment, as I've already said. And we expect it to be like an elongated L shape, not linear, it's more or less curvilinear, like your indifference curve. As you can see below, according to the Phillips curve, there is an inverse relationship between the unemployment rate and the inflation rate. In the image which is depicted, an economy can either experience 3% unemployment, a 3% unemployment rate at the cost of 6% inflation, or increase unemployment to 5% in order to bring down inflation by 2%. So if the economy is to experience a reduction in the inflation rate, say of 4%, from 6% to 2%, the economy has to make do with a 2 percentage point increase in unemployment, as you can see there. A 3% increase in unemployment initially from zero is associated with a 2% decline in the inflation rate, and so on. So this is what we mean by this trade-off. The history, as I've already told you, the theory is associated with the studies that were done by the economist Arthur W. Phillips. So in his original treatise or paper, Arthur W. Phillips tracked wage changes and unemployment changes in Great Britain from 1861 to 1957, and discovered a stable negative relationship between the rate of change in money wages and the unemployment rate. But in the 1960s, the economists Paul Samuelson and Robert Scholl expanded this work to reflect a relationship between inflation and unemployment in general. Initially, it was the rate of change in money wages, which is your wage inflation and unemployment. But later on, Paul Samuelson and Robert M. Solow expanded the analysis to inflation in general, since wage inflation is a key component of inflation in general. But it was discovered that in the 1970s and afterwards, the classic Phillips curve relationship did not remain stable. I mean, when fitted to empirical data. So the relationship sort of broke down. So what is shown on this slide, slide number 6, is a fitting of points for unemployment data and inflation data for the United States of America for the years 2000 to 2013. If you look at the scatter diagram, the points in this graph, you realize that there is a downward trend. The points, they start being up at the beginning, and then it's like the cluster is going down, such that the line of best fit will be a downward sloping line, seeming to imply the short run Phillips curve. We would expect that for data of 14 years from 2000 to 2013 inclusive. The relationship between the Phillips curve and aggregate demand in an economy. When we look at changes in aggregate demand, we would expect them to cause movements along the Phillips curve, all other variables held constant, or with the ceteris paribus assumption in operation. Changes in aggregate demand translate to movements along the Phillips curve. If there is an increase in aggregate demand, such as what is experienced during demand pull inflation, there will be an upward movement along the Phillips curve. As aggregate demand increases, real GDP and the general price level increase, which lowers the unemployment rate and increases inflation. So movements or changes associated with our aggregate demand, they translate to movements along the Phillips curve. And then what follows is just a rehashing of the definitions, especially the definition of the Phillips curve that I've already given you. And I can rehash the definition of aggregate demand. It's the total demand for final goods and services in an economy for a given time and a given price level. The schedule which shows a locus of points where the coordinates are your equilibrium national income and the general price level, or rather national income and the general price level. So what I was describing, the movements along the Phillips curve associated with changes in your aggregate demand is depicted on slide number 9. If you look at your aggregate supply curve, naturally would expect it to be upward sloping because of the issue of increasing costs, dynamic costs in the long run, and the issues to do with technology in the short run. The issues to do with your marginal cost both in the short run and in the long run is upward sloping. So naturally, would expect the short run aggregate supply curve to be upward sloping as well. But look at your 80s, your 81, 82, 83, up to 84. They are all downward sloping. And as they shift upwards, just moving along the same aggregate supply curve. And point A is point A on the short run Phillips curve. Point B is point B on the short run Phillips curve, up to point D, which is that point on the short run Phillips curve. As you can see, as aggregate demand increases from 81 up to 84, in other words, when there is demand pull inflation, because there is demand pull inflation and then cost push inflation. When there is demand pull inflation, naturally would expect the inflation rate to be increasing, which according to the short run Phillips curve relationship, or according to the dynamics of the Phillips curve relationship, would translate to a lowering of the unemployment rate, as the rate of change in money wages, or rather the rate of change in the inflation or the inflation rate, according to the thesis of Paul Samuelson and Robert M. Solow, as the inflation rate increases, we expect unemployment to decline, the rate of unemployment to decline. So I've already described that. What follows is just a summary on slide number 10, which are which slides I'm going to share with those students that I take for central banking and monetary economy, CPA 5213. But it suffices for me to say, as more workers are hired, unemployment decreases. Moreover, the price level increases, leading to increases in inflation. So more workers will be hired due to increased aggregate demand. But the hiring of these more workers, it will be associated with increased inflation in the economy, which is what is shown by the shifting of 80 from 81 up to 84. which is a movement along this short-run Phillips curve from A to P, translating to a dynamic decline in the unemployment rate and a dynamic increase in the inflation rate. Now we want to examine the long-run Phillips curve. The long-run Phillips curve is a vertical line at the natural rate of unemployment, which is such that the inflation rate and the unemployment rate are unrelated. We wouldn't expect the short-run relationship to exist in the long run. So the relationship between the two variables would actually break down. The natural rate hypothesis, or the non-accelerating inflation rate of unemployment, called the Nairu theory, predicts that inflation is stable only when unemployment is equal to the natural rate of unemployment. If unemployment is below or above its natural rate, inflation will accelerate or decelerate. What do I mean by the last statement? What I simply mean is that if the unemployment rate is below its natural rate, inflation will accelerate because there will be room to reduce unemployment by demanding more workers, not just demanding more things in an economy. We know that for things to be available in the economy, which is your aggregate demand, it also entails more workers being employed to make those things available in the economy, ceteris paribus. But to do so, it implies an acceleration in inflation. But if your unemployment rate is above its natural rate, then we would expect inflation to decelerate. Expansionary efforts to decrease unemployment below the natural rate of unemployment will result in inflation. So if you try to suppress unemployment below its natural rate, only leads to an increase in the inflation rate. This changes the inflation expectations of workers who will adjust their nominal wages to these expectations, not in the short run, but in the long run. In the short run, they may be incentivized to avail more of their labor effort, but in the long run, they will realize that inflation has eaten into the rise in their nominal wages and thus decrease their labor effort. You will have more of voluntary unemployment in the long run, even though there was a nominal increase in wages in the previous episode or previous period. By the natural rate of unemployment, this is a hypothetical or a theoretical unemployment rate which is consistent with aggregate production being at the long run level, or it's a scenario in which the theoretical unemployment rate is coincident with the full employment, a scenario which is called full employment in economics, the full employment level of national income, for instance. And then the non-accelerating inflation rate of unemployment, which is NAIR, is a theory which describes how the short-run Phillips curve shifts in the long run as expectations change. According to economists, there can be no trade-off between inflation and the unemployment in the long run. Decreases in unemployment can lead to increases in inflation, but only in the short run. In the long run, we expect inflation and unemployment to be unrelated. And this concept of Nair, it was promoted by economists such as Milton Friedman and Edmund Phelps, who are leading, or who are leading monetary economists. I mean monetarists, not just monetary economists, but monetarists. Milton Friedman is late, to the best of my knowledge. And he was a leading monetarist in the Chicago School. So according to the Nairu theory, expansionary economic policies, like your expansionary monetary policy, only create temporary decreases in unemployment as the economy will adjust to the natural rate. And how does the economy adjust to the natural rate? through workers' expectations. Through workers' expectations. We assume the economy starts at point A according to the slide that appears, according to the graph that appears on slide number 14. And there's an initial rate of unemployment and an inflation rate. If the government decides to pursue expansionary monetary policy, inflation will decrease. It can be expansionary fiscal policy, but yes, since we are doing central banking and monetary economics, we'll assume the expansionary monetary policy. This causes inflation to increase as aggregate demand shifts to the right. When aggregate demand is shifting to the right, it will also be shifting upwards, an upward shift. And this causes a movement along the short run Phillips curve, up the short run Phillips curve, thus explaining the temporary decrease in unemployment as the aggregate demand schedule is shifting upwards due to expansionary monetary policy. So in the short run, we are able, ladies and gentlemen, to move from point A to point B. We are able to navigate from point A to point B, which is this movement along that we saw earlier on. This movement along from point A to point B that we saw earlier on as your aggregate demand increases from 81 to 82. But we know that workers being, people who are able to incorporate expectations of inflation in the future, they are able to adjust in the long run. When they see inflation acting as an indirect tax of some sort on their incomes, and the unemployment rate will increase, fall back to the natural rate of unemployment, which is the non-accelerating inflation rate of unemployment, which is just above the this artificially low rate of unemployment. As you can see, we can readily see the interaction between the short run Phillips curves and the long run Phillips curve. When workers' expectations adapt to the dynamic effects of inflation on workers' wages in the long run, the worker or workers will no longer be operating on the initial short run Phillips curve, but on the final short run Phillips curve, which implies that the unemployment rate will migrate from that low unemployment rate, which is coincident with point B, to that higher unemployment rate, which is actually the non-accelerating inflation rate of unemployment, or the NAIR, which is coincident with our long-run Phillips curve. So this is what I've just been explaining, that expansionary monetary policy or even fiscal policy, it translates to a movement along the same short-run Phillips curve. And this movement can be ad infinitum as long as we are in the short run. It can continue indefinitely, not really literally to infinite, but it can continue indefinitely. But as we approach the long run, whenever the long run will occur, we'd expect this PC to actually shift upward, the ceteris paribus. And now we just want to examine a bit fast the historic situation in the 1960s and the 1970s. And in this examination, we have to define adaptive expectation. The theory of adaptive expectation states that individuals will form future expectations based on past events. For instance, if inflation was lower than expected in the past, individuals will change their expectations and anticipate future inflation to be lower than expected. Excuse me. To connect this to the Phillips curve, we consider the following scenario. We assume an economy starts at point A, the natural rate of unemployment, with an initial inflation rate of 2%. It has been constant for a number of years. Therefore, accordingly, because of adaptive expectations, workers will incorporate the 2% inflation rate into their reasoning and expect it to continue, so that the expected increase into this expected increase is factored in wage negotiations in the future. This way, their nominal wages will keep up with inflation. It will be 2% versus 2%, and their real wages will in actual fact stay the same. Now, when we translate this to the Phillips curve relationship, which we are starting, according to the theory of adaptive expectations, policies designed to lower unemployment will move the economy from point A to point B, a transition period when unemployment is temporarily lower at the cost of high inflation. As we move from point A to point B, the unemployment rate decreases from 5% to 3%. But look, your inflation rate increases from 2% to 5%. So it means a 2% decline in unemployment is purchased at the opportunity cost of a 3% increase in the inflation rate in the short run. Now, eventually, the economy will move back to the natural rate of unemployment at point C. How? It will move backwards according to what I explained earlier on. The effect of inflation acting as a tax on nominal wages. According to rational expectations theory, policies designed to lower the unemployment rate will move the economy directly from point A to point C. So according to the rational expectations school, the economy moves straight from point A to point C, not via point B, because the rational expectations school of thought or approach does not have this notion of workers incorporating what was happening in the past into their reasoning and labor wage bargaining exercises in the future, or collective bargaining exercises in the future. The transition at point B does not exist, as workers will be able to anticipate increased inflation and adjust their wage demands accordingly, if we assume rational expectation. So at the short run, Phillips curve, according to rational expectations, will just be shifting from SRPC1 up to SRPC2 up to SRPC3, not via these other points. But if it is adaptive expectations, we move from point A to point B to point C to point D to point E, like that. So I've already explained that. So rational expectations, according to this view, the theory of rational expectations states that individuals will form future expectations, not based on what was happening in the past or what has been taking place, but based on all available information, with the result that future predictions will be close to the market equilibrium. What does this imply in terms of what we are covering? Because this rational expectations code does not only apply to the dynamics of inflation and unemployment, it applies also to aggregate demand, aggregate supply relationship, as well as other variables in macroeconomics or concepts in macroeconomics. To contextualize this notion of rational expectations to what we are covering, we assume that inflation was lower than expected in the past. Individuals will take this information and current information as well, such as the current inflation rate and current economic policies to predict future inflation rates. So how does this translate graphically? Graphically, it translates to a situation where we are moving from point A to point C, from point C to point E. So there is no notion of transitioning via point B or point D. How the long run Phillips curve is related to aggregate demand and aggregate supply. In the long run, we expect long run aggregate supply to be vertical, just like your long run Phillips curve. So what happens if there are changes in aggregate demand? Because we know that the long run aggregate supply curve will be coincident with the full employment level of national income or the natural rate of output in an economy. So if that is the case, it implies that any expansionary or contractionary policies that are meant to affect aggregate demand would just yield a movement along the same stagnant or fixed long-run aggregate supply curve. And this will translate to just a movement along the long-run aggregate supply curve, which doesn't yield any increases, any real increases or decreases in the natural rate of output or in the full employment level of output, which also automatically translates to a movement along the same long-run Phillips curve, which is vertical. So as your aggregate demand increases, we know that the general price level will increase due to increased money supply, which is what I've just explained. And this increased money supply will fuel inflation in an economy, the ceteris paribus. So the trigger is an increase in money supply, which increases aggregate demand, which is what we mean by expansionary monetary policy. An increase in money supply is one of the instruments that one may use in order to stimulate aggregate demand so that it increases. But then this has the effect of triggering an increase in the general price level from P1 to P2, which is also shown in the second panel as a movement of the inflation rate from a lower point to a higher point, and as a movement along the same Phillips curve from A to B. So again, we go to the short run Phillips curve with low expected inflation at point A. And then you have your expansionary policy moves. The economy moves up along the short run Phillips curve until it attains point B, especially if we assume adaptive expectations. Especially if we assume adaptive expectations. So I was just explaining that when we assume adaptive expectation, as the as monetary authorities engage in expansionary monetary policy, the economy will move along the same short-run Phillips curve from point A to point B due to expansionary monetary policy. But because the inflation rate has increased, workers will realize that their real wages have not really increased. And then the short-run Phillips curve will shift to the right, yielding an intersection at point C there. So what follows are just case study information, which you can easily verify from the internet. I don't need to dwell on this. We've covered the key basics. So historic events have shown that the short-run Phillips curve can shift due to changes in expectations. So the recurring theme or the recurrent theme is that expectations are able to impact the behavior of your short-run Phillips curve. And when there are shocks to aggregate supply, these shocks may cause shifts in your short-run Phillips curve. Major adverse changes in aggregate supply can worsen the short-run trade-off between unemployment and inflation. An adverse supply shock gives policymakers a less favorable trade-off between the inflation rate and the unemployment rate. There's a supply shock. What is a supply? It's an event that directly alters the firm's cost, and as a result, the prices they charge, like the war in Ukraine, the war in Ukraine. Like the war in Ukraine. For instance, the war between Russia and Ukraine. Some would say the invasion of Ukraine by Russia, but what has resulted is a war between the two countries. Granted, Russia has got more firepower and other military resources or assets, but again, it's a war situation, which has caused a sharp increase. It has caused a very sharp increase in the price of fuel. And other petroleum products. Prior to the war between Russia and Ukraine, fuel in Zimbabwe used to be around $1.30, between $1.30 and $1.40 per liter. And now, after Russia invaded Ukraine on 24 February 2022, yesterday, when I was looking for fuel, I discovered that diesel, a liter of diesel is now $1.74, which is an increase of more than 20 cents from 1.74 minus 1.3, 1.34. Let me just say 1.34. It translates to 40 cents, almost half a dollar increase due to a supply side shock. The uncertainty which is associated with war in Russia. We know Russia is the third largest exporter of crude oil to the whole world. Contributes a lot of crude oil to the global system, the global economy. So the war in Ukraine has caused the short-run aggregate supply curve to shift from AS1 to AS2, which will cause the output or the output of many economies to decline, say from Y1 to Y2, and the general price level will increase. Definitely in Zimbabwe, it will increase. In America, they're already talking of inflation beginning to increase because of the adverse shock associated with this war between Russia and Ukraine. So we know there was a very serious shock associated with crude oil as well when OPEC decided to cut production in order to raise worldwide prices to improve the economic conditions or the income or revenues of countries that form this cartel called the Organization of Petroleum Exporting Countries. And this shock shown in this complicated relationship between the inflation rate and the unemployment rate, basically showing that the shock caused the classical relationship between unemployment and inflation to actually break down, because you see this movement, which is like a coil of some sort. So if there is disinflationary monetary policy in the long run, this disinflationary monetary policy will cause a movement along the short run, Phillips Curve A, from point A to point B, where the unemployment rate has increased because we are trying to push inflation down. And then, but in the long run, of a movement from point B to point C as the economy shifts to a lower short-run Phillips curve. And then you have the concept of the sacrifice ratio. To reduce inflation in an economy, we must endure higher unemployment and low output. So higher unemployment and low output, or higher unemployment and low output at the opportunity cost of lower levels of inflation, so to speak. So the sacrifice ratio is actually the number of percentage points of annual output which you are prepared to lose, or that is lost in the process of reducing inflation by 1 percentage point. So you can have different figures for different economies, economic situations. So thank you so much for listening in. I believe you benefited from this quick coverage of the dynamics of the relationship between the rate of change in money wages and the rate of change in unemployment, or the inflation rate and the unemployment rate. Thank you so much for listening in. Good morning.